What are fair value gaps? Fair value gaps are just candle number 1, 2, and 3. It's just a pattern of 3 candles where candle number 1 doesn't overlap with candle number 3. So in this case, this is candle number 1, 2, 3. As we see, this is the top of candle number 1. This is the bottom of candle number 3. This gap in between the 2 candles becomes the fair value gap. Let's go live into some examples immediately. We got candle number 1 here, candle number 2 here, candle number 3. As we can see from the closing of candle number 1, which is here, there's this volume imbalance in between these 2 candles. We include that in the fair value gap as ICT taught in 2024. We no longer do it like this. We do it like so. We then put the bottom of the fair value gap on the top of candle number 3. If we drag that across, we can then see price react to this level very nicely and hold price below it. Now, fair value gaps are not just magical things because they do happen quite often in many areas that sometimes get taken out, like here, for example, or here, and so on. So what you want to do is you want to pair fair value gaps with other forms of trading, like liquidity, as well as draw on liquidity. So for example, here we can see a CISD on the bottom. We can see this fair value gap here on the top. Price comes back up, reacts off of it, and just kind of makes some highs, makes this high here, and leaves this high as well here. And so we have relatively equal highs from that high to this high being made. Price aggressively jumps up, runs those two, the fair value gap holds, and then what do we have? We have another fair value gap, another CISD, and then we have price kind of just come back as slowly. Again, highs, those get ran, CISD, and after the CISD, fair value gap. So you could have had an order here, just kind of pending, waiting for it to get tagged. In this case, it didn't. So at some point you delete it, and then you move it on to the next one. The next one has liquidity, meaning highs being ran. You have a change in set of delivery, giving you direction and bias, and then you have the fair value gap, giving you the actual entry. You can enter on the open, you can enter in the 50% or the top. It just depends on the overall idea. Stop loss goes above candle number 2 or candle number 1 to be the safest. Personally, candle number 1 will always be the best bet. Candle number 2 can be quite risky unless you understand what you're doing because there will be wicks that do damage. And so it will often dig into candle number 1, spike you out like here, for example, and then run. Another example can be seen here after price had already dropped. We have CISD. We have relatively equal highs. Those get ran. We have a new CISD here, swing low. Swing high, swing low, swing high. We close below it here. So now we have a change in set of delivery. And then we can drag the fair value gap across. You could have entered here on the retap on the open, and you would have just had to hold through. Now, as we can see, the top here candle holds. So your stop loss never would have gotten ran if you did candle number 1. If you did candle number 2, you would have gotten stopped out, and then price would have ran without you. We then can see after this entry happens, we then have another entry to the right. We have, again, highs being ran, the actual top holds. We then have fair value gap. This is the change in set of delivery that we're going to be anticipating. And so, because this is an entry instead of another entry, we can just take this as is, and you would have gotten tagged in. Again, there's a volume imbalance between these 2 candles, so you add that across. Stop loss goes here. TP wherever the draw on liquidity is. So this is a really brief explanation. Obviously, fair value gaps can go and be bullish, and so the bearish are called CBs, and the bullish are called BCs. And so you'll be seeing me reference those throughout the videos. But as you can see, fair value gaps, again, are not magic. While this is a fair value gap, the draw on liquidity is, again, lower. We can see that we're trending downwards. And so what do we have here? We have a high, another high relatively close. Those highs get ran. We have a change in set of delivery once again. And we have the first fair value gap here on this leg. Drag it across. Price comes back in, tags you, and you're in the trade.